You're listening to the Rent Roll Radio Show with Sterling Chapman. Hey, Rent Roll Radio listeners, welcome back to the show. As always, I'm your host, Sterling Chapman. Today, we're joined by Neil Wahlgren. He is the COO of MAG Capital Partners. Neil, welcome to the show.
Thanks for having me, Sterling. Appreciate it.
Awesome. Well, Neil, can you tell us a little bit about yourself and kind of how you got into the real estate world?
Yeah, absolutely. So right now I'm running capital markets as the COO for MAG Capital Partners. Just in short, we're an investment firm. We do largely syndication. We pool capital from retail and high net worth investors. And our specialty, our niche, if you will, is in the industrial space. And we do single tenant net lease. So long triple net 20-year leases with largely what are called sub-credit tenants, a lot of manufacturing firms. And we actually, as part of our niche, we buy most of our real estate through sale lease-back, where we're buying the real estate and then simultaneously leasing it back to the operators.
Wow, there's a ton of questions around that because that's a very niche environment that you're operating in right there. We have a lot of syndicators on the show, but typically they're aimed around like a multifamily traditional apartment syndication. So it sounds like maybe you didn't come about this through the same old story that we hear. So I'm curious as to kind of how you got involved in that niche, how you got involved more broadly in real estate, how you landed in that niche. And could you, elaborate a little bit more on the process and why did you say that you're buying the asset and then leasing it back to the same person you bought it from?
Mm-hmm. So yeah, a little bit about me, my background. I was actually an Air Force pilot for about 10 years. Ended up switching over to the Navy for a few years after that, got my MBA, and then got into the private sector and ultimately had the opportunity moving back to the San Francisco Bay Area to get plugged in with kind of a family friend who originally had a business model where we would raise capital from a network of investors, and then we would partner with commercial developers or brokers who really had access to good commercial real estate projects, could put together a good project, but lacked access to capital. So we would be essentially the capital investor arm for that. And what was kind of neat about that was I had a chance to really get plugged in with experts who were very good at kind of a niche model, across the board. And we had, maybe about 6 or 8 different folks we would do repeat deals with. And we had our multifamily guys who strictly did apartments in, Northeast Atlanta. We had a, multi-tenant retail group and, just a number of them. And one of those groups was MAG Capital. And we raised money at the time on a partnership level for about 3 of the projects. And I, especially having seen a lot of the other asset types, I really liked the single tenant net lease industrial model. Just most of the work is done up front, where, you're negotiating the lease, you're negotiating the purchase price for the asset. And then if you do your homework right and you get it all set up in a way that makes sense, they are the most sleep easy investments, in my opinion, out there. They're cash flow focused, they're 100% occupied. And most of these tenants are strong, really like business to business oriented manufacturing firms in the Midwest. Most of them have been around 30, 40, 50 years. They're making core B2B type products, everything from like industrial mixers, dryers, high density foam end caps for shipping appliances and electronics. Some are co-packers who make frozen food goods, and basically will sell to retail focused brands who put their own label on it. And, really that kind of, essentially products one step away from the consumer.
So why are they selling you the property in the first place if they just want to lease it back from you? What's the benefit on their end?
Great question. It typically coincides with a recent sale of the company to a private equity group. And so private equity groups will buy these businesses because they believe they have the skills and the capital to inject into the business to grow the business at a substantial clip. And ultimately, oftentimes those businesses with that sale to the PE groups, it comes with the owned real estate. And so PE groups, really, they can't get the returns they're looking for by owning real estate. And they prefer to basically extract the capital that's tied up in the building and reinvest that into the actual operating company. So that's the drive behind why.
So could they not accomplish something similar by just doing some type of loan against the property?
Yeah, no, great question. There's several advantages. So typically a loan is going to be limited to roughly about 70% loan to value. On a sale leaseback, you can extract 100% of the value. And then on the flip side, there's tax advantages too, where you're able to write off 100% of rent as an expense on the company's bottom line. Whereas from a mortgage, there's limits to how much of that mortgage interest you're able to write off. And it's usually much lower than the amount of rent you would be able to. So those two factors there are the main reasons why companies will do that. And they're just able to extract money more efficiently from that compared to a traditional refi or a mortgage.
Is there any additional like liability type benefit from them not owning the property? If they have a lawsuit or accidents on the premises, is there any benefit for them not owning it?
If it was a gross lease, yes. However, most of these transactions are all structured with absolute triple net leases. So they basically maintain that full level of responsibility, everything from insurance, taxes, maintenance, utilities, all the things that they were responsible for as an owner. The way these leases are structured, they have full control still, but they maintain full responsibility and liability for all the expenses with the property.
Awesome. So what kind of risk do you run with single tenant deals? Is there a higher risk versus kind of diversifying it over multiple tenants?
Yeah. And especially folks who come in from the multifamily background, I use that as a common comparison because it's where a lot of people get their feet wet in commercial investment. And the idea of you're kind of taught, hey, like spread that risk across a lot of renters and suddenly you can lose a few and still be fine. And the idea of a single tenant can be a little scary. The way we look at it actually is a little different in that it is a concentrated risk, but it's a risk that if you do your homework and are able to, really understand it, suddenly you have really not a lot of operational risk in a project's success. It all boils down. So, to put it another way, we are essentially buying a very predictable set of cash flows that come from that rent. There's no expenses to disrupt those cash flows. So we know with a high degree of certainty, down to the cent, the amount of money that is coming in even a few years from now, right? Mm-hmm. And then those cash flows are governed by the brand new lease that we put in place and the language in that lease. And then the risk is essentially the tenant credit. Ultimately, if that tenant defaults on the lease, probably through a Chapter 11 bankruptcy event, that's really the only way that those cash flows are disrupted. So it really comes down to how do you analyze that credit risk, which is ultimately where the risk in your deal lies. We do what's called sub-investment grade. And so you have kind of two categories of tenants in the space. On one side, you have an investment grade, and that's going to be really more name brand companies, right? Your Amazons or your Wahlgrens, or, and you'll see these deals on LoopNet on the market. They're credit tenants. They have publicly traded, they have outside credit agencies giving them credit ratings. Your Moody's, S&P will give them a, AAA minus or a BBB plus, whatever it might be. And that's an objective level of their credit worthiness. And it's nice. You know very well where those guys stand. You can feel good about it. And ultimately, the risk is pretty low, but consequently, the cash flow is going to be low as well. Those might only cash flow, say, 3 to 4% a year to investors. What we play in are what's called sub-investment grade. So usually they're still strong companies, typically $60 to $80 million a year. They're not big enough to have an outside credit agency. Mm-hmm. So we actually do that work ourselves. So we have a credit advisory team in-house because it is a huge part of our business model. And these guys, they go and they'll produce a 6 to 10 page credit memo for every deal we look at. And they're looking at, kind of the basics, financial summaries, balance sheets. They look at the amount of debt these guys have, their profitability, EBITDA margins. But then they take it a step further and they go, hey, with a sale leaseback, these guys are getting a big injection of cash from the sale of the real estate, right? How are they going to use it? Are they paying off the owners who's going to go, take it to Bermuda? Or are they, investing this cash back into the business? Are they paying down corporate debt? Are they reinvesting in capital improvements, new manufacturing lines, new headcount, whatever it might be? And that's really a huge piece of the puzzle to find out, hey, how are these proceeds going to be used? And is the company going to be better off on the tail end? And then really that's what we're most concerned with is what that company looks like after.
Do you have any, I mean, could they just tell you they're spending the money on something and then after you close the deal, go spend it on something else? Do you have any way to hold them accountable to their presented business plan?
Not necessarily in terms of that side. I mean, usually, they're pretty frank about it. These are private equity groups. They have a very repeatable business model. There's not a lot of teeth you can do to force them to use it in a certain way, but a lot of it's just good business practice. And they'll be upfront about it. Sometimes there's usually some portion of the proceeds used to pay off some owner equity, and they'll be very upfront about that piece too.
Got it. So how are you finding these types of deals?
It's really interesting. It's a little different than your standard commercial broker network, going on LoopNet or commercial brokerage listings, in that I would say it's a kind of a boutique skill of the brokers and private equity groups who play in this space, because you're not just negotiating price of real estate. You're also at the same time negotiating terms of the lease. So just to use an example, you might have a seller who says, hey, I want to maximize proceeds, and I'm willing to pay a higher price per square foot on my rent on the tail end. Or another guy might say, hey, I'm looking for, a low rent for 20 years, and consequently, I'm willing to sell this property on the low end of the market. And those are, just kind of an example there that there is a bit of an art form in terms of balancing those two to find a win-win. And at the end of the day, we're looking for yield, right? Yield basically boils down to what kind of cash flow are we getting for our investors, and what is the risk that's attached to it? And that, the risk piece we talked about, and then the cash flow comes in the negotiation.
So what does your typical investor look like? Are you mom and pop in it, or are these more institutional players?
For our group, we've really found success in working with both retail investors, professionals, doctors, lawyers, and also some high net worth individuals. We syndicate. So we'll pull together sometimes 20 to 40 individuals for each of the projects that we take down.
What do the typical returns look like on one of these projects?
They're actually based on our criteria. We have a fairly narrow guideline. So, we're usually buying properties, between about a, roughly 7 to 8.5 cap range, typically in the Midwest. We're finding a nice risk reward ratio out there. And, most of these deals, we target 8% or higher of cash flow from day one. And then we're usually able to actually increase the cash that goes to investors based on pre-negotiated rent bumps in that new lease. So most leases, and really it's designed as a way to hedge against inflation. So, if you have a 20-year lease, if it's a stagnant lease rate, you're going to be losing real purchasing power of those dollars as everything else inflates around it. So what we do is we do, most of our leases have roughly 2% increases per year. And that'll flow on to our investors, annually increasing.
So what's your typical hold time for these projects?
Yeah, that's a good question too. Some groups will come in and say, hey, we're going to hold this for like 15 years. It's just going to be cash cow all the way down. We found a nice little niche of roughly about 5 years. And it's not an arbitrary number. The reason we do that is we are the front end of a new long-term lease because we're the creator of it. And what's nice about that is a releasing event has inherent risk around it. Is your tenant going to release? If they do, are they going to ask for, extra TIs, concessions, whatever it might be, especially if the market's in their favor at the time? We have decided, hey, we just want to own the early lease portion for an investment horizon. We usually will hold about 5 years. There's still roughly 15 years left on the lease. And that's an attractive sale to the next buyer. And we're selling to either pension funds, institutional buyers, REITs, 1031 buyers, or sometimes even investment groups similar to ourselves.
Awesome. Do you see a lot of crossover between like the multifamily syndicators over to your space? Is it kind of like a logical progression you find?
It's interesting. I don't think the industrial single tenant space belongs as 100% in anyone's portfolio. However, especially, as you get older, I think that consistency outweighs the potential of a large value add multifamily, for instance, just to, use an example, or a development. Sure. In that I can look an investor in the eye and tell them with a high degree of certainty that, hey, even like 4 years from now, this is the exact amount of monthly distributions that you're going to see. And, it's not affected by things like COVID. It's not affected by market factors, at least not in the same way as you're going to see in more aggressive value add projects. And that consistency is really refreshing to a lot of folks. Just to use an example, in 2020 with COVID, we had about 22 projects under ownership. And I mean, literally the entire time, the portfolio just performed. I mean, there was no hiccups. Tenants paid rent. We paid our distributions. These are strong companies that have been around almost a half century on average. And, they have good cash reserves. They know how to weather a storm through a recession or an event like COVID. And they did. And they all came out, really strong on the back end as well. So we were fortunate on that side.
Did y'all not have any interruptions, or did y'all not feel it financially? So what I mean is, did you maybe have a warehouse get shut down because there was an outbreak, but the company that was renting it from you had the cash reserves to float it until they got back to work?
Yeah. Every single property except for one was deemed essential and able to keep operating. So we were, just fantastically lucky. And I realized, COVID, all the provisions, who's essential, who's not, who could have seen that coming, right? Like that. A lot of that is luck, right? But, we were fortunate to be in a space that was deemed largely essential, core manufacturing. And the one exception, we actually had a health club out in the Midwest, and they were forced closed in March. And we actually worked out a pretty good deal with them where we gave them a 4-month forbearance and said, hey, basically you're going to accrue interest, put a pause on your lease payments. Mm-hmm. And at the same time, we were able to negotiate the same deal with our lender, who said, all right, you'll accrue interest, put a pause on the mortgage payments. And then after 4 months, everyone just resumed like clockwork. You amortized the missed payments into both sides. And, it worked out. I think the tenant was stronger now, far stronger than they were, back in March. They actually have acquired a few competing health clubs in the area and, are quite a bit larger. And then the bank was happy and, it ended up being a win-win for everyone there.
Awesome. So what other differences do you see in your space kind of versus some other niche areas that we typically learn about?
Yeah. Do you mean from like an investor's perspective or broker, sponsor?
From all directions.
Sure. I think it's interesting to look at real estate through the eyes of a different set of criteria. And what I mean by that, so, for example, multifamily, right? And I'm going to use that. I love multifamily. I have some multifamily investments of my own, but it's the asset class that people know most just because they're most exposed to it. And it's usually, again, that starting point. So, in a multifamily deal, you're looking at your metro and your demographics and your submarket are so crucially important for the success, especially if you think you can turn this thing around, right? If you're going to put $1 million of CapEx and do renovations and you think you can improve the rents and the occupancy, like really having a deep dive into that submarket is crucial, right?
Location.
100%, right? But on the manufacturing side, it's a little different where, don't get me wrong, like location still is important, but I can deviate from, a major metro comfortably as long as I have increasingly strong tenant credit. So, for example, we are pursuing a deal right now where it's about 20 or 25 miles outside of Detroit. And it's fascinating because it's kind of tertiary, not going to lie, but the tenant credit is phenomenal. And this company, actually their parent company is signing a full guarantee on the lease. And the parent company does almost $500,000 a year in revenue, double-digit EBITDA margins. Just a powerhouse tenant. And, having that substantiation allows us to comfortably venture out a little bit further out of a major metro because of the decreasing likelihood of having a default on that lease. So, especially with a relatively small investment horizon of about 4 or 5 years, you can sleep pretty easily there and go, hey, I feel good about this, and I'm willing to take a sub-secondary metro there.
So you're not necessarily hunting buildings as much as you're hunting businesses that have buildings to sell you.
100%.
You're hunting the business, not the geographical 4 walls.
Yep. And the valuation, especially with these long-term leases, the valuation of that building increasingly correlates to the strength of the credit much more than any other asset class does. So we still have, fundamentals. We're still looking at, hey, does the price per square foot of this real estate make sense in the metro? or make sense with similar, long-term net leases. But at the end of the day, we get a much better comp of a similar lease, even 2 states away, than I would in the metro, comparing my 20-year net lease with, say a 3-year lease of a competing product there. So the strength of the lease and the strength of the tenant are much, much better indicators of the real risk and reward of the project.
Awesome. What differences from an investor perspective might one notice?
Yeah, I mean, really, I would say your upside is capped and your downside is capped. So, you're not going to have 30% returns on a standard net lease play. But on the flip side, your consistency, in my opinion, is substantially higher.
So you said something earlier that kind of, I want to say, did you say older, something in reference to kind of older folks? And that's just like 101 traditional financial planning, right? In the early years, we do these high cap stocks, and then they go into bonds, lower performing, more consistent. So it sounds like something that as you get older and less risk tolerant and more in wealth preservation mode versus trying to grow, that's something that might be a better fit.
Yeah, 100%. And because we're playing in this sub-investment grade that I talked about, historically, we've achieved high teens in terms of our annualized returns to investors. I mean, it's been really solid, beating, quite a lot of other asset types, in my opinion. But it comes down to... Actually, I read an interesting article. I'm going to deviate slightly here. Sure. And it was making the case that single tenant net lease sale leasebacks are the new bond investments of our era. And hear me out why, right? Like 20 years ago,
that
30 years ago.
That was the connection I just made.
Yeah. I mean, because before you used to, especially when interest rates were higher, right? You used to be able to, really buy a bond with a fairly fixed yield. It was typically on an annualized basis, between 6, 7, 8, sometimes even 10%. And it was essentially fixed to the credit risk of the company it was tied to. And you had a high degree of certainty with it, right? But as interest rates have compressed to near zero, bond returns have done the same. And frankly, right now, they're not a very competitive investment category. Sure. And these allow you to still hit those yields, especially year to year. Now it's tied to a lease instead of the actual directly to the company credit, but the risk of that lease is still tied to the same core function there. So, I think from that perspective, this is a way to still get yield tied to the credit of, frankly, a strong company if you do your homework right.
Awesome. So what's next for y'all? Do y'all have any plans in diversifying out or any other business asset classes y'all are entertaining?
We really, niche is rich, right? And we found this single tenant net lease sale leaseback model we do well. And it's a skill set that I think not a lot of people have, just because it's a smaller addressable market than, larger, say, multifamily as a whole. So we'll probably stay in this field. What we have seen some opportunity for, which has been kind of fun, is especially if we're buying real estate from a manufacturing firm that's recently been acquired by private equity, if they do their job right, and we've seen this successfully several times over the last couple of years, if they do it right, their business can substantially grow, sometimes double, triple even over, a relatively small amount of time. And we've had clients come to us, tenants come to us and go, hey, we need to expand, right? We love this site. We have land. And we say, hey, you know what? We have space here. We can expand your facility by another 60,000 square feet. We have a facilities manager and a GC on staff. So we will actually directly oversee the expansion. We'll get debt often from the same lender that, lent to us on the core real estate. They are even more bullish about the project now because the company is theoretically increased and strengthened in size. And now we're able to really turn what originally is kind of a stabilized deal into a value add. It ends up being really great for investors, really great for the tenant. And, they're more happy with the new space at the end. And we'll pre-negotiate before the add-on starts to say, hey, when this is done, here's the new rent rate across the board. You have far more square footage. And once we hand over the keys from the expansion, now your cash flow has increased substantially higher. And yeah, it's a great way to kind of turn one of these, more steady Eddie deals into a nice value add pop.
Awesome. Well, how would you direct somebody who wanted to learn more about this niche?
Yeah, education first, always. We have some stuff on our website is magcp.com. I'm happy to talk both from an educational side and obviously from an investor connection side. And you can reach out with any questions or even comments on the podcast. My direct email is Neil, Neil at magcp.com. Also, there's several big REITs that have some pretty good education out there. Store Capital is a good one. Store. They're publicly traded. There's also Stream Capital Partners. Both of these are big single tenant net lease REIT players that have a lot of education on their websites as well.
Awesome. So I want to hop over real quick to our radio round just to help our listeners get to know you a little bit better. First question we got is, what's your favorite book?
Oh man, I'm going to probably deviate. I don't know if I'm supposed to say a real estate book here, but
I've never specified, and about 75% of the guests do use real estate books, but I've had some far off ones.
Yeah, I'm in it all day long. I'm not going to lie. I like more recreational reading for myself. I've been reading a book called Why We Sleep, and I find it fascinating. I mean, and really just to tie it in, I mean, your sleep wake cycles, your alert kind of down cycles. I mean, the better you understand those, the better you can, I found you can just optimize every minute of your day to know, hey, like I don't need to fight my circadian rhythm. I don't need to fight my body's natural flow. And if I can work around what I realize already exists here, I can be way more productive. And anyway, it's been eye-opening.
I learned early in college that the whole cramming all night, sacrificing sleep for productivity was a fool's errand. And I haven't tried to do it for a very long time. My wife jokes that when I don't get sleep, I'm like those Snickers commercial when the actor turns into Joe Pesci or Betty White when they're hungry.
Oh yeah, man. You get a little hangry, right?
Yeah. When I don't get, 8 hours or 7 hours, I'm worthless.
So much of your passions and your day-to-day life is tied into how good that sleep is, right?
Absolutely. So I'm going to have to check that one out. What is your favorite quote?
My favorite quote, it does change, but right now I would say it's a Truman quote. There's no limit to what can be accomplished if it doesn't matter who gets the credit.
That's an excellent one.
Yeah. I learned that back in the Air Force Academy, and it was one of our required reading, quotes in our little pamphlet book, all these kind of key quotes. And honestly, like the older I get, the more I just work with teams and, kind of find mutual success. It's fascinating how true that is, that, just pay it forward, and take care of your people. And it always comes around indirectly. So.
Yeah. Having spent so many years in corporate America, I think they should have that quote on the wall of every single room across
right?
the country.
For MBAs, man, yeah. I went through, an MBA program at Texas A&M, and, I love the program, love the people, but I swear to you that it seems to attract folks that are just like succeed for myself no matter the cost. And, I think this would be a great start and finish the day quote for these guys.
Yeah, for sure. What's your favorite thing to do outside of work?
I love flying. It's
you're a pilot.
My guilty pleasure. Yeah. I did it for 10 years with the Air Force, and I'm in a flying club out here in the city in San Francisco.
What do you fly?
Just a little 4-seaters. The flying club, I got a little Cessna 172, and, I'll take up friends and family and investors sometimes. We'll putter by the Golden Gate Bridge and go buzz downtown and Alcatraz and go out to Napa, grab some wine and some food. Oh, I'm not drinking wine if I'm flying. Real smooth landings there, right? But yeah, it's been great kind of mixing that with my professional endeavors.
You don't have any fear about flying? I always wondered why so many more non-commercial airlines crashed than commercial airlines.
Yeah, no real fear. I probably should be a little more concerned sometimes, especially, traveling to far corners of the world. It all comes down to training, right? The U.S. military does just a bang up job and, training their pilots years and years and thousands of hours. But yeah, it just comes down to having good habit patterns, having good discipline, checklists, standardization, and not deviating from what works. And if you stay in that, you'll fly safe and every time.
Awesome. That sounds exciting. I'm working up the courage.
Yeah. What about you?
Outside of work, I have a 18-month-old, and I'm having another baby on Monday.
Congratulations.
So, I like to do a lot of outdoor sports and barbecue, but these days outside of work, life pretty much revolves around babies.
Totally get that. Totally.
So I feel like I kind of jumped the gun earlier on this question, but I did want to give you an opportunity to put any more of your contact information out there. How can people get in touch with you, get a hold of you, learn more about Mag Capital? And
yeah, absolutely. So again, I'll just put out the email there is the best. Any comments, questions, any inquiries about the investment process, or if you're interested in joining the group, you can just reach out, Neil, Neil, at magcp.com. Neil at magcp.com.
Awesome. Well, thank you so much for joining us, Neil. You were a most interesting guest we've had in a while on a very different topic that we haven't had a chance to cover. So really excited that we were able to get this information out to our listeners. And I was personally very, very intrigued by the topic and look forward to kind of learning some more about it.
Absolutely. Well, thanks so much for having me on, Sterling, and appreciate it.
All right. Thanks. Thanks for tuning in to the Rent Roll Radio Show, brought to you by Crestworth Capital. We hope you enjoyed the show, and if you did, please hit the subscribe button and leave us a rating and review. You can also visit us at crestworthcapital.com or rentrollradio.com, or follow us on Facebook at Rent Roll Radio or at Crestworth Capital. If you would like to reach us, feel free to shoot us an email at info@rentrollradio.com or sterling@crestworthcapital.com. We hope you come back next week to join us on some more of our journey. Until then, happy investing.